Holy crap, the US economy totally just flipped. As the US Federal Reserve pulled back their forecast for rate cuts, the three major US stock indices all hit back-to-back all-time highs. Real estate sales had their highest percentage increase in a year, and Janet Yellen just acknowledged that she regrets using the word transitory when it came to inflation.
So stupid.
And in this video, we're going to discuss all the most recent economic news and also discuss what you should be preparing for just in case inflation doesn't come down and those interest rate cuts that everyone has been hoping for don't actually materialize. But before we do, my name's Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. Okay, so let's jump right into the news here and take a look at what's going on in the US economy. And most notably, the biggest news in the US economy this week was not that the Fed held rates steady, but that they pulled back their forecast with respect to rate cuts for this year, going from predicting 4 potential rate cuts in December of last year to now predicting only 3 and having them come later in the year than originally expected. And this is largely due to the unexpected increase in GDP that, well, is spurring on the US economy. Some of this coming from new immigration and some of this spurred on by the boom in AI technology. And unfortunately, that increase in GDP may cause inflation not to fall as much as originally expected and could lead to higher rates for longer. And let's be clear here, the Federal Reserve is definitely taking a wait and see approach. And if the economy continues to run at full steam the way that it is, don't be surprised if the US Federal Reserve changes their tone with respect to rate cuts in the coming months. Now, one thing that I love to look at when it comes to the Federal Reserve and what they're expecting is the Federal Reserve dot plot. And what this shows is where various members of the Federal Reserve Board sit with respect to their expectation on future interest rates. And as you can see, the majority of the Federal Reserve Board, well, the majority, maybe not the majority, but the largest percentage of the Federal Reserve Board expects that interest rates are probably going to end up this year somewhere between 4.5 and 4.75%. But this isn't the part of the dot plot that concerns me. The part that concerns me is the 1 or 2 outliers that seem to be predicting that interest rates are going to remain not just high, but at the same level into 2025 and into 2026 being just marginally lower. Now, this is just one individual on the Federal Reserve Board, but what it does indicate is that there's at least one person on that board that thinks not enough has been done yet, and that we could see an economic situation that warrants higher rates for significantly longer. And I'm not going to lie, but the recent news with respect to the Dow Jones and the S&P 500 and the NASDAQ kind of indicates that that could be a possibility, as these different stock indices continue to reach all-time highs, which is typically a pretty good indication that there's a lot of confidence in the market, perhaps too much confidence. And as we know, when there is too much confidence in the market, that can often be inflationary in itself. Because as consumers expect things to get better or expect that things are pretty much remaining the same, they will start to act differently, which often indicates they will spend more money, do things like buy more homes or bigger homes, which could lead down the road to more inflationary pressure, which would of course lead to higher interest rates. Or in this case, interest rates probably not coming down as much as many people expect. And we're already seeing signs of overconfidence in the US housing market, as February home sales hit the strongest pace in a year as mortgage rates ease and more houses hit the market. So in other words, as interest rates are coming down, it seems the consumers are starting to buy more homes. And again, that could be problematic for pretty much the entire economy, especially if houses continue to sell at the pace they're selling and continue to increase in value at the rate that they've been increasing in value. And one thing you might note here is that I've now shifted to using a service called Ground News. And the reason for that is because of the echo chamber that now exists in the media. And what I mean by an echo chamber is that certain media outlets are delivering news on certain stories and ignoring other stories based on the news outlet's political leanings. And what ends up tending to happen is as you follow one news source, you start to be fed information that is very much biased. So I started using Ground News recently to make sure that the news that I deliver on this channel is very much center and factual, as opposed to being left or right leaning. And what Ground News allows me to do is find the news stories, figure out whether the headlines are right or left leaning, and then also dig deeper to find news sources that are significantly more reliable without political bias. And not only is ground news a place to find unbiased news and to identify blind spots, but it is also one of the best aggregators for news I've ever found, meaning that all the news that I need is all in one place at my fingertips based on the preferences that I provide. So if you want to get ground news for yourself, I've put a link in the description below. Yes, it's an affiliate link and it helps support the channel. So use it if you like, but make sure that you're using a service like Ground News when you get your news so that you know that you're not being led astray. Now, digging in a little bit further to the real estate story here, I want to touch on some of the highlights. Most notably, existing home sales climbed 9.5% last month. That is a big increase over January. And more importantly, it's the strongest sales pace since February of last year. And that increase in sales caused median sales prices to climb by 5.7% year over year, which if the market's expected to collapse, why are we continuing to see higher prices, more sales, and just very much a strong market, not just in the real estate market, but in the stock market and pretty much every other major market out there. But that's not the most interesting news from this week. In fact, the most interesting news, at least in my mind from this week, is Janet Yellen saying that she regrets saying inflation was transitory. And this goes back to our previous conversation about consumer sentiment and the impact that it has on the economy. Because when people start to believe that an issue is not an issue, well, it can create greater issues. So in other words, when everyone believed that inflation was transitory, myself included, and all of a sudden it turned out that it wasn't, well, that caused people to act in a way that led to more and more inflation and bigger problems. And this is why central banks need to be so careful about the things that they say. Because a central bank saying something like, we think there's only going to be 3 rate reductions instead of 4 this year, versus saying, we're not even sure there's going to be any rate reductions at all, has a significant potential impact on the economy. So even though there's that one individual on the Federal Reserve Board,
there's always one guy
who's saying, I think interest rates are probably going to have to stay the same until next year, the majority are not going to make that same statement because those very statements alone could impact where inflation goes and what happens with interest rates. So the Federal Reserve, with respect to communication, is playing a balancing act of making sure that they don't say too much to scare people while also not saying too much to raise confidence. But here's what we need to pay attention to. We need to make sure that we're paying attention to the trends. And right now, the trend is towards more GDP growth. Yes, inflation is coming down, but things seem to be getting better and better in the economy, which in an ideal world will lead to what's called a soft landing, which is where inflation and interest rates and everything all kind of harmonizes and there isn't some massive recession that causes lots of job losses and lots of pain. But just because that is what feels like is happening doesn't mean that we aren't still at risk. So before you read things like interest rates are going down and everything is going great, make sure you take into consideration that forecasts are just forecasts. And think back to when the Federal Reserve in 2020 and 2021 was saying interest rates are going to remain low for a very long time, and then they didn't. Because when the Federal Reserve now says we may see 3 interest rate cuts in the next year, well, it is very much possible that that won't happen. And the biggest risk is that there's some sort of surprise in the economy that leads to a spike to inflation that causes interest rates to not actually go down. So what does that mean for you and me as consumers? Well, what it means is that we need to create guardrails just in case what is expected to happen doesn't happen. And what I mean by guardrails is that we create a financial moat around our proverbial financial castles so that if things don't happen as expected, we are prepared. And the way that you do that is simple. Don't take on additional debt if you don't have to. In fact, everyone should be doing as much as they can to pay down the existing debt that they have. And in addition to that, make sure you're living well below your means. If you're living paycheck to paycheck, now is the time to take advantage of the positive aspects of the economy and try to start putting money away on a monthly basis so that if things don't go as expected, you've got some money to fall back on. And on top of that, remember that reducing your debt is reducing risk. If you can readjust your living situation to maybe a smaller house with a smaller mortgage, this might be a good idea to take advantage of the higher real estate prices and do just that. But at the end of the day, this is all about mitigating your own financial risk. And I can't emphasize this enough as somebody who's spent the last 20 years selling debt. Debt is risk. And the less of it you have or the less you're obligated to pay, the better you will be off financially. So think about that when it comes to the amount of debt you have, the amount of money that you're borrowing for various things, and the size of the mortgage you have relative to your income. Oh, and if you want to see an interesting video on how you might be able to get cheaper real estate commissions in the future, make sure you check out this video right here.